Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, February 10th, 2022. I've already fired off several charts out to you this morning, and I wanted to follow up with a video just to kind of reiterate what I'm seeing and also to reiterate or share my convictions on this. There are times, I always give you my opinion. I mean, that's what this is all about. That's what you're paying for. I do technical analysis and try to figure out where things are going, identify opportunities in the market, and doesn't matter whether it's a cryptocurrency, a commodity, an individual stock. If I can chart it and you can buy it with a few clicks of the mouse, I will trade it regardless of whatever the fundamentals are. Market sentiment on it. Now, with that being said, there are times, I'm going to share setups and developments I see, and I may have a stronger or lesser degree of conviction on that, and I'll always share that, and then let you decide. Hey, here's the levels, here's support, here's resistance, here's some trend lines to watch, here's other things, some moving averages, and then some trades look better than others. This one, I just wanted to say that on a scale 1 to 10, it's close to a 10. So what I was talking about this morning when I said on that last post that I sent out with IWM, this right now, this kickback to that 208.50-ish level, again, that's a year-long trading range, super well defined in IWM. That's the bottom of the range right there. We got in that range back in the beginning of the year right there, late 2020 or early. There's the year break right there, and we've tested it so many times. So again, the bigger these ranges are, it's like building energy like a coiled spring. I know I repeat myself a lot, but if you're new to the site, that's the analogy I use in trading range, and that's a big one. That went over a year before it finally broke down, and throughout that we had one major event, other than each time you got to the top you get rejected, you go down to the bottom. But this was a breakout. It did several things. Number one, it proved to be a false breakout, and I always say that fewer things in trading and investing, when you're using charts, fewer things are more bearish than a failed long side breakout, just like failed downside breakouts are very bullish. Why? Because a couple things happened. Number one, it was a breakout of the trading range, very well defined, a lot of clean reaction highs there, so you get a lot of longs that take it. It's also a breakout to all-time highs. That is always on face value a bullish technical event. Why? Why is a stock or an index at all-time highs bullish, whereas in a stock at all-time lows is bearish? Because every single person, bar none, no exceptions, every person holding IWM when it breaks out to new highs is profitable. You have no remorseful holders that want to get out, that are just dying to get out. Likewise, when a stock hits a 52-week or especially an all-time low, it means everybody that owns that position. Again, I'm speaking mainly to people that have been in it. There's people get in that day traders, but I'm talking about the investors. They're all underwater, and they're all feeling the same way, and that way is not good. So what happens there is it brings in new buyers, both on the breakout above a trading range, in this case, and as well as one to all-time highs, and it clears out a lot of the shorts, because a short should, again, should have, if you've been shorting the top of the range, once you recognize it, that's your MO, that's where your stop should be somewhat above. And it was just enough to do that. And so what happens, the reason why false breakouts, failed breakouts are so bullish is, number one, you get a lot of new hands, new money coming in, and then their stops, they decide to pull the trigger there. You also get the shorts. This cleared out short interest, and that is actually a bearish thing, because I always say this: shorts are the only people in the market, I'll use it in the word person or entities if it's an institution, they are the only guaranteed buyers of a stock. What I mean by that is, you could get a hedge fund manager come on TV and say, I love XYZ company, it's got the great fundamentals, one of my favorite stocks right now. Well, he or she may or may not buy that stock. They may or may not already own it, and even if they had all intentions to buy it, something may change their mind. But when you short a stock, you must, at some point, you must buy the stock to close your position out, buy to cover. And that's why stocks with high short interest, we saw that with AMC and some others over the last year, tend to have big moves because those shorts are being forced out. And so stocks with a very low short interest, or when it drops, it leads away here because as it falls, you don't have those short sellers taking profits anymore. And again, I'm kind of generally speaking, it doesn't mean every short seller got blown out, but that's what happens, and that's why you saw that big move. So again, that was a very bearish technical event when it happened, and it sent us right back down to the bottom of the range. And as you know, just like Pavlov's dogs, I always use that example in psychology. You know, ring the bell, or and the dogs start salivating. They think they're going to be fed because that's what he did. He conditioned them, and so dip buyers are conditioned to buy the dip. Then support broke, and then it was such an important support level. You can see a waterfall drop down from 2,850. You know, we dropped in just a matter of just a day, a few days, a week or so, about a 9%, biggest drop in a long time, especially that whole thrust down there. Okay, so that's what happened, and then when we started getting there, we hit my first target on I was mainly focused on QQQ. We also had a target or support level on SPY that was hit, and then I added this line and said that we'll probably get a reaction here at 191, and that's what we did. So this is it. So breakdown. And look, again, I would much rather be wrong on this than to not just share my convictions of how objective it is to short a bounce back to that level. And you know, give it a little room if you are targeting 170. That's still the longer term swing target. And again, this was a bounce that was when the large caps hit support, and you had divergences, other things like that. Then you took out a trend line. So reaction there was the most likely scenario, and I said it at the time. And it's been pushed us back up to really about where the maximum I wanted to see this bounce go. Now we can still go. Here's the thing. Look, we're well below. These are the 200-day exponential and simple moving averages. There was also some decent resistance here about 215. So we could certainly go up. And so what I was trying to say this morning, whereas, you know, your stop is going to be your stop. Let's say you had zero position in IWM and you shorted right here at 2850. Then what you do, or what I would do, if that's your total cost basis, and you're targeting a drop down to 170, that's 18%, over 18%. So you can easily allow a 6% stop loss, and that gives you a nice 3-to-1 risk-reward ratio, and that would allow then for a back test of the 200-day simple moving average right there. But let's say you want to short, but you don't think we're going down to 170. You just think my targets are too aggressive, but you think we're having another test of the lows, and you just calculate it. That would be a drop of, it's in the pop-up box to the left, about 8%. So then you might want to use 2 or 3%, something like that, stop loss, and that would be right there, maybe around that, a little above that 215 level. And then finally, as I said before in that post, you know, ideally when volatility is high, intraday swings are high, and you are trading off the longer term, the daily charts or the weekly charts, all that matters is a close on that time frame. So if you're trading on the daily charts and your stop was, let's just say 215, you might consider holding off and not setting a hard stop. Now, I know if you don't do this full time, there's really not an easy way to do it. Some brokers might have some kind of order entry that'll say, hey, stop out at 215, but not if it's taken out intraday. Only if we're heading into the close, it's 359, and we're going to definitely close above 215. That's what I'm talking about, because that allows those intraday, like, you know, there was that overshoot. If you probably can't see it in the video, but there's a long shadow there. So we hit, give you that 190-110 support right here. We hit it, we bounced. That bottom of that candle was almost perfectly on it. So was that one. This one had an intraday break, so you would have been stopped out because you would have seen these two previous reaction lows, but only to see the big reversal that day, and IWM closed well above it. So that was a successful defense of the 191, 191.10, if you want to call it, support level on a daily basis. It got taken out intraday, and that is almost to be expected when volatility is high. So that's just kind of a trading tip. And if you're trading on the weekly chart, you're really playing the long game here. You can wait for a solid weekly close. Let's say you want to say, okay, I don't want to see us close back in the trading range. You could also look, there's a trend line right there. There's, on the weekly, I have the number at 209.23, give or take. And so there's your 200-day moving averages right there. So the downside to going with a weekly stop is that a lot can happen during the week. You could have closed the previous week just a little bit above your stop range and then have a really strong rally. There's no easy solution, but again, it's you need to consider your stops relative or commensurate to your targets, your swing targets, where you think things are going. But again, based on everything I've covered, it's not simply that we're bounced back to resistance. That's not it. There's everything else I've covered for weeks, even months now: sentiment and market breadth deterioration, and the macro, picture of the fundamentals that rates are going up. And look, this market, if it's been anything, if you want to put one word on it, it's been resilient. There's still a ton of money that's been injected into the system. Yeah, the Fed's slowly backing that away, but again, in my opinion, others way too slowly. But it's still there. And if you look at it this way, today we saw a big reversal in the big drop in the futures, followed by a big reversal. Inflation came in hot again. That's here to stay. So I think what that did immediately, it almost instantly it bumped the odds even higher that we're going to see a 50 basis point hike. I talked about that before. And instead of a 25-point hike at the next meeting here in March, coming up next month. So either way, I'm not going to talk on it anymore. I'm just going to again say that this, if you miss this, and I know some did, and that's just the nature of this. I always get people, hey, Randy, where should I? I'm like, no, now you can't go aggressive. This is my aggressive short entry here. This is where I just layered in today when I got those charts out to you, and SPY and NQ and ES, and NQ and IWM are my favorites, but that's where I'm pretty much chock full. And now I'll just, since I went in heavy, some of the positions I'll have to start scaling out if we start punching on through here and taking out the levels that are nearby resistance levels. I don't do all or none. I like to scale in and out. And again, I'm speaking to now as a trend and swing trader, or wear multiple hats. I give you a 5-minute chart. Those are quick day trades in and out. So at any one time, I can be long or something in my IRAs, or have multiple accounts, longer term accounts, even if they're non-IRAs. And then at the same very time, short that security for a quick, bounce 1-2%, especially if it's the stock futures. They're leveraged, and you can make, in a single day, what depends how much you want to put into there, but you can make a lot of money by just getting a 1-2% bounce in NQ, even a single contract of NQ. It's going to give you thousands of dollars if you just get a 1-2% bounce. All right. Let's go to the other ones. Let's go to SPY and QQQ and maybe the futures, and we'll wrap this up. SPY, this is again big picture. We were just on a weekly chart at NQ, so pick up here with SPY. There's our primary uptrend line. There's the divergence that's been building. There was a divergence that was building into the big drop in COVID, so it wasn't random. COVID, yes, certainly accelerated what was being priced into the charts, and we have big divergences have been building. Broke down recently. Also had that trading range in SPY. It wasn't as long as IWM, and that's it. So on this weekly chart here, there was the range. It was an all-time high in the S&P 500 right here. We broke out above it, back tested it for several, these again weekly candles, several weeks, back tested. Finally, the back test failed. So that was a big, major, important sell signal. And now you can see we're just simply back testing that level. This is a weekly candle. So this is why I like this level. We're at the point where ideally, and again, you don't always get what you want, but ideally, this is where we should stop. The rally should stop in this candle, which is a little bit above that 451-ish level right now. It's going to look different. One way or another, it's going to look different unless we somehow happen to close on Friday, tomorrow, exactly where we are now. But if we reverse then you're going to see so far it's just simply a breakdown and a back test. And again, that's a weekly chart. So then you can go down to the daily and you can see it there. There's that same trading range right there. Let me try to drag the box. And again, that comes back really to that all-time high there. It's back tested. So boom, boom, boom. And let's look at QQQ. I'll get to the futures. And I'll wrap this video up and get out to you guys. So there's it, hit the bottom of the T1 zone on the daily, which was a hard level on the weekly chart. The other day, told you we had this, we had a bounce, downtrend line. That's the bounce off the initial tag. That's why I list multiple targets. And again, I'm focused now on the weekly because I'm playing the long game. That's what the analysis I'm talking about here, a longer term trend trade. Hit there, bounced off there, and look. What's been going on lately, I'm going to zoom in nice and tight. We've been back testing the 200 days. The red is an exponential, the blue is a 200-day simple. And it's more than common to see a little brief spike above day or two. So we tested the 200s there, got rejected. We went in this little trading range for the last few days, popped it, but now we're back. We're testing the top of that now. So this is important. This was another rejection off the 200. In fact, this one was perfect. Look where the algo stepped in. And again, it wasn't just this. That's not what I showed you this morning. I knew that was there, but I can only, copy and start, screenshot and annotate so many charts. So I got out what I thought was the most important levels. But that's it. So far, a rejection. Look, you can't go high five in if you're, if you shorted it because it's so far. Not much, I'm sorry, that was yesterday and today again, I should say. That was yesterday, parked on it. Today we hit it intraday, and that's where the reversal came in. You probably can't see it in the video, but there's a little skinny part to the candle right there called the wick. That means that was today's high. So yet another rejection off the 200. And that is when you go back and look at past corrections and bear markets that had taken out the 200-day moving averages, you'll see that quite often it was tested over a period of a couple weeks, several tests, and then if it can't get through, then that's bearish. So that's what you're looking for. So if we start moving lower, especially I think now that we've had several days of consolidation there, this is the number. I think this is a magic number that will really do the trick. I keep talking about this was waterfall selling. This is what I'm talking about. And if I'm right, we're going to have another leg down soon. This is when you're short and you're pressing them hard. If you're leveraged up on the NQs or QQQ, whatever you're trading, this is where you make the money. And then when it starts to not be objective to stay short anymore, in other words, when you hit a price target, when you hit key support, when you have divergences on the 60-minute time frame, oversold on the daily, which I pointed out here, that's when you start reducing or completely closing out that short exposure if you are an active trader. But I also spoke to the longer term where this is where all our short entries were here and every time we came up here. So if that's where you're at and you're a long-term trader and you don't have the time or the inclination to trade all these counter trend bounces, you're still very profitable and you're looking fine right now. And at worst case, there should be no reason at all that you should lose money if your average short entry, cost basis was up there. At very least, your stop should be there. And ideally, I would lower it at this point, maybe halfway into the range to assure at least a small profit in case I'm wrong and something happens in this market manages to just power on through and shrug off the fact that we're looking at a beginning of a new rate hiking cycle, almost certainly. Okay, and if we don't turn down here, there's still plenty of room to go to, have a typical retracement. Remember, last week I highlighted an objective short entry here, and that was at you probably can't make it in the video, but it's right there. It's this yellow line right here. That's a yellow dashed line that comes in at this level, and we made a retracement. That was a the 50% retracement, Fibonacci retracement from the all-time high and that whole initial leg down in QQQ to when my first target was hit. And at the very same time, the S&P 500 hit the 61.8 Fibonacci retracement, and I also said, that's also a potential bounce target for the Qs. It would still keep things within a typical counter trend bounce range, and that also comes in the 61.8 is right there, about 380. And then there's price resistance just below it. But as of now, look, all the better if we stop at the 50. And so far, that's what we did. And now that was a powerful thrust off that first support level. A lot of buyers stepped in. Again, the dip buyers, because that's what they're conditioned to doing. It works so good for so long. How can they not? So they did. They bought. And so what's going to happen now is we have a pretty significant reaction high there. And we just made a lower high. Bulls want to see that previous high get taken out, and then that gives you more. It's the makings of a near-term uptrend, because an uptrend is defined as a series of higher lows. There's our first reaction low, 2, 3, higher lows and higher highs. That's what defines. So if they can take out that high, they're going to have a higher high. It doesn't mean we're going to all new all-time highs, but it certainly starts to increase those odds. Whereas the bears, or those that are short, want to see these previous reaction lows right there get taken out. And it's also this area of consolidation recently. And a lot of people stepped in and bought there, and that was also back test of this recent consolidation range. So this is what I want to see. It would be ideal, and also put in, now a lower high and take out those lows. That I think should get us down there. So we'll see. All right, the S&P 500, we're almost done. SPY, I already gave you IWM. SPY, there it is. That was a 61.8 fib retracement right there. There's the level, there's the line. And as I mentioned in the post I got out to you today, we got checked at that 61.8. It was an objective shorting up. We got rejected off it. We got rejected again. There's also, as I showed you on the futures, there's a downtrend line off the highs. I covered that in yesterday's video. And that's also where we got rejected. And there's price resistance. I have it at 458 right there. I have price resistance 458 because we had a major reaction low there. We had several reactions from below. There was a big old gap there, quite a bit down there. So price and fib resistance, and as I mentioned in the with the futures and in the video yesterday, negative divergence. We got it. We got that equaled that high. That's what it looks like in SPY. When you go to ES, here's the chart I got out to you today. There's the downtrend line. There's our divergent high. We made a marginal, slightly higher high with clear negative divergence on the indicators. The last time that you had negative divergence on the 60-minute chart on SPY was right there, and that was the biggest drop in a long time. Followed that. Before that, divergent high there, and divergent high there. So that's what we have on SPY. NQ didn't quite make it because it failed to even take out that previous high. So and again, this is showing me that weakness in the market leaders. They're really lagging, and so far, again, you just want to see that this about 14,424-ish level, because that was the top of that consolidation range. We came in, broke above it, back tested a couple times, so we need to take that out, and that is pretty much it. That downtrend line's not too clean on NQ, so I'm just going to leave it off and just watch those levels. Okay, I told you I'd wrap it up, but on a somewhat related note, because it's all intertwined, I like what I saw this morning. So inflation numbers came in hot. The initial reaction, futures plunged. They had a sharp drop this morning in pre-market, QQQ going down, and then it got bought up. The euro immediately sank. The dollar surged. Why is that? Well, if inflation's still running hot, 44-decade plus highs, 7.5%, I believe, now annualized rate. And again, I think that's understated. That just, again, further solidifies the case for rate hikes. In fact, it probably sharply increased the odds, my guess, for a 50% hike. But, so what happened? So the euro this morning on that tanked. This is when it came out right there at 8:30 a.m. Eastern time. Look at that big drop, one of the biggest drops in a while. But look what happened. Boom, they busted it up. See, what I think is whether, it's a known fact now. Powell's, boxed in a hole. He's going to have to raise, but I think we're going to start to see the ECB pivot. And if not, I don't care. Maybe I'm wrong on what the ECB is going to do, with rates over there. But all I can tell you is the technicals. Everything I've been watching. Here's that trend line right there. There was that divergent low, bullish falling wedge, and there was that little bear flag. Bull flag. Remember I talked about flagpole, and boom, pulse a pop. Now we're at that resistance. If we can follow through from this, and I think today it was probably stopped out a lot of dollar bulls and euro bears. Yeah, exactly. The reversal had stopped them out. There was a nice reversal, but bottom line is this bull flag's breaking out right now. You can see that, and again, resistance right here. We need to pop these recent highs. And that's going to be, if that happens, which is still my preferred scenario, that's going to be quite bullish for gold and silver. And they also had a pretty big reversal today. So I just wanted to share what's going on there as long as I've got the mic. All right, guys, let me wrap it up here. You can get the video out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.